Hey YouTube, it's Matthew Decker with Cash Value Life Insurance Reviews. I also run Leveraged Wealth Management, where we specialize in cash value life insurance as an alternative asset class. And one of the questions that we get asked all the time is, hey, this looks great for me, but what about for my kids? Should I put these types of cash building life insurance policies on my children? And today I thought we'd really quickly cover juvenile policies. So this video is going to be pretty short and to the point and really just be more of a pro and con list of cash value life insurance policies for juveniles. So let's start with the actual pros of juvenile policies. So the first thing that you have to understand is cash value life insurance, unlike a Roth IRA, does not require any earned income. So there's no earned income requirement. Now, what that means in a nutshell is this: if you wanted to go out and get a Roth IRA for your child, they would actually have to have some form of W-2 income. They would have to have a wage that the IRS can see in order to qualify or be able to put money into that Roth IRA account. And they can't put any more into the Roth IRA than what they actually have as earned income. In cash value life insurance, we don't have to worry about that at all. You can contribute to cash value life insurance on behalf of your son or daughter, no matter if they have earned income or not. And that's a huge pro over something like the Roth IRA. The second thing that's a huge pro to cash value life insurance, and we're going to kind of stick with this theme of comparing it to the Roth IRA, is there's no 59.5 rule. So that's a huge benefit, especially for someone who's maybe 12 years old. You put money, let's say that you're a 12-year-old, or you have a 12-year-old or a 13-year-old daughter, and maybe they work for you. You own a business and they're on your payroll for the purpose of being able to contribute to a Roth IRA, which is something that is kind of a tax hack there if you want it. But they can't touch that money until they're 59.5. I should be more specific. They can't touch the gains on their Roth IRA account until 59.5. Otherwise, there's a 10% penalty. And so in cash value life insurance, we don't have to worry about that. There's no earned income requirement. And then that second thing is you can tap into that cash at any time for any reason without paying any penalties imposed on you by the IRS. And that's a huge pro over the Roth IRA. Now, I told you that I wanted to keep this relatively short, so we're only going to hit on one more pro to juvenile policies. And I guess we could list all the pros of cash value life insurance, but that's not the focus of this particular video. We're really tailoring it down to policies for kids. The last pro is time. You got a 10-year-old son or daughter or a newborn baby. My goodness, you put 10 premiums into that thing and you've got the benefit of being able to wait 30, 40, if you're talking about retirement income, you might be waiting 50 years until tapping into that policy. And so you get the benefit of time value of money, which is something that is really hard to quantify when you just kind of sit down and think about earning interest. Einstein called compound interest the eighth wonder of the world. And when you start looking at juvenile policies and the cash values that can build up over time, it really quickly comes into focus just how powerful having more time really is. So those are the three pros of cash value life insurance for juveniles. But let's talk about some of the cons, because there are some cons and they should be talked about. So the first con that I just really quickly want to mention is parents will need coverage. So we'll just put parents will need a policy. Now, these limitations are carrier by carrier. And so not every single company is going to have the exact same rules and regulations as it relates to juvenile policies. But by and large, if you're going to buy a policy on your kids, the insurance company that's doing this transaction for you, they're going to make sure that you also have insurance. And a lot of times they'll put restrictions or they'll impose limits, and they'll say, well, you can only buy as much coverage up to 50% of what you own on yourself. And so if you're a parent and let's just say you have a $400,000 policy, what the company might say is, okay, if you're going to do policies for your kids, the max that you're going to be able to buy from a death benefit standpoint is $200,000 because that's 50% of what you have on yourself. And you may think, well, $200,000 is way more than my kids need from an insurance standpoint. And that may be true. In fact, I'm sure it's true. But if we're talking about a 3-year-old buying a $200,000 life insurance policy, that may be $100 a month. It's not going to be a lot of money that gets funneled into that contract. And, the less money you put in, the less you're going to get out ultimately. And so that's just something that you need to be aware of. It's not an unlimited amount of death benefit that you can buy on your kids. And typically you're going to have some insurance. And a lot of times it's 2x whatever your kids will have. The next limitation that I want to make sure you know about is some companies, and really most companies, the good ones, if let's say that you have 2 or 3 kids, so you've got a 1-year-old, a 4-year-old, and a 7-year-old, they're going to tell you, hey, if you want to buy that $200,000 policy on the 7-year-old, that's great, and you can absolutely do that. But we're going to require you to buy the same $200,000 policy on your 4-year-old and the same $200,000 policy on your 1-year-old. And what they're trying to avoid there is essentially you putting a ton of insurance on one kid. That creates a situation that insurance companies don't like. So a lot of good insurance companies will require you to buy a policy on each of the kids that you have, and the policy has to be similar in some way. So we've levelized it for death benefit, but they might also levelize it for premium. So if you wanted to pay $250 per month on your 7-year-old, then they would say, well, you're going to have to pay the same $250 per month on the 4-year-old and the same $250 per month on the 1-year-old. They might be different death benefits, but if the premium is the same or if the death benefit is the same, they're going to consider that roughly the same policy. So that's the second thing that you really need to be aware of on juvenile policies. You may have to buy one for each of your children. The third thing that I'm going to tell you, I don't think you're going to believe, and it's because you're used to seeing a policy for yourself. And policies on parents and adults, they're priced differently than juveniles. But here's what's crazy. Juvenile policies are not priced well. And I actually have an example here that I'm going to show you. But if you look at a policy on a 16-year-old kid, and you compare that to a policy on maybe a 19-year-old or a 20-year-old or a 21-year-old, the 16-year-old's probably going to have worse rates. And the reason is because the 16-year-old just learned how to drive. The 16-year-old hasn't turned 18. They're not allowed to buy cigarettes yet. The 16-year-old hasn't turned 21. They're not allowed to buy alcohol yet. And so there's things that juveniles have not yet been exposed to in the real world. And the insurance companies don't know how kids are going to react to being able to drive the first time or, buy things for the first time when they're 18 years old. They might go into the military at 18. So there's all kinds of variables that juveniles are kind of unexplored on for the insurance company's standpoint, whereas an adult, the insurance companies kind of know, the 35-year-old adult with 3 kids is probably not going to enlist in the military. If they don't have any drinking related issues at this point, hopefully chances are they're not going to develop any. And so they're just not priced that well. And I'd like to show that to you. So I actually have an example here between 2 kids. So we have a 17-year-old, and so this would be a juvenile rate. So here's our 17-year-old. This is a male juvenile rate. We're looking at a $5,000 annual premium. And when we pay that $5,000 annual premium, we're getting about $150,000 death benefit. And if we pay that premium for 15 years, and then let's say we stop paying that premium, we let this policy continue to cook for several years and turn this into a lifetime stream of income 35 years down the road, this 17-year-old's policy is going to generate $29,000 a year, which is awesome. I mean, you put in $75,000 in total into this policy. And over life expectancy, let's call it 87, you've taken out $1 million. So you put in $75,000, you've taken out $1 million. There's $366,000 left over in the form of a death benefit at the end of this policy. I mean, that's a phenomenal return on the dollars, considering it's tax-free and not subject to market risk. And the reason it looks so good is because we've got 70 years here to watch this thing grow. And that's that time value of money component that makes these policies look really compelling. So here's what I want to focus in on though. 75,000 in, just over $1 million in total distributions, 366 left in the form of a death benefit. If we total all that up, that is $1.41 million in total distributions from this particular contract on our 17-year-old. So what I want to do though is I want to show you an 18-year-old. 18-year-olds are considered adults. They do not get juvenile rates. And in fact, when we look at the illustration, I mean, you can see this is normally where you would see the rate class right next to the name and age, and it's a juvenile rate class. There's only one rate class for kids, and it's called juvenile. Once you turn 18, that's when you get exposed to all the different rate classes: standard, preferred best, preferred plus, or you could be rated lower than standard if there's some health issues. So it goes both ways, but once you turn 18, you get opened up to all the rate classes. And so I want to show you what that would look like, an 18-year-old who is healthy. So here's our 18-year-old with our preferred plus rate class. And it's the exact same policy. I mean, we're putting in $5,000 a year. We're putting that $5,000 in for 15 years. We've got just under that $150,000 death benefit. And we're going to do the same thing here. We're going to take retirement distributions in the same year, year 35, which is where we were on the 17-year-old's policy. And the 18-year-old, who's 1 year older, who you would think, oh, they're older, so their insurance rates are worse. The 18-year-old is generating $32,000 a year, tax-free for life with no market risk. And if we go out to the same year 70, they've taken out $1.15 million in total distributions with basically the same $366,000 left over in the form of a death benefit. That's a total distribution over those 70 years of $1.52 million, tax-free with no market risk. And again, they're 1 year older. And so this just kind of highlights the last con, which is juveniles are actually not priced that well. And so if you have a 17-year-old who's about to turn 18 and you want to get them a policy, what I would tell you is go ahead and get them a policy, lock it in, but you can actually go back through underwriting once a child turns 18 and hopefully qualify for something like a preferred plus rate class and actually improve the policy and get out of the juvenile rates. So I hope the things that you've learned from this video are, number one, juvenile policies can be absolutely powerful for kids, mainly because they have the advantage of time. The second thing is they are more flexible than a Roth IRA, and really there's no question about that. Way more flexible than a Roth IRA. Easier to get into one, easier to access your dollars. And then lastly, they're not priced very well. And so if you've already purchased a juvenile policy, you might want to put a little calendar appointment in your iPhone or in your Google Calendar that when they turn 18, you should reapply with the exact same company in order to get them into one of these better rate classes where they're not stuck with that juvenile rating for likes. So hopefully this has been helpful. Again, this is Matt Decker, Leverage Wealth Management and Cash Value Life Insurance Reviews. We specialize in cash value life insurance as an alternative asset class to help build wealth. Until next time, take care.